Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a concept that is liquidity. Now, liquidity in itself is a very important thing in any business or in any firm or in any activity, because without liquidity, no business can function. And there are some of the examples like cash, bank, and those are some of the most liquid assets. So let's understand what this concept is all about. So liquidity is basically the ability of the firm to pay off the current liability. Current liability means the liability which is going to get accrued or which will materialize within 1 year of time span with the current assets it possesses. So both the liability and the assets will materialize in at 1 year of time span. Let's understand what exactly liquidity is. See, liquidity is the ability of the firm to pay off its current liabilities and the current assets with the help of its current assets which it possesses. So before investing a huge sum in any investments, every company needs to look at their liquidity so that they can ensure that even after investing into projects, they will have enough cash and cash equivalents, right? Or cash and liquidity basically to pay off its current assets. Now, there are two ratios which can ensure that whether the company has enough cash or not. The first one is the current ratio, and the second ratio is the quick ratio. Now, all the company has to do is to look at their balance sheet at the time of any investment and see the current assets and you can say the current liabilities, and then compute these two ratios, the current ratio and the quick ratio, and the asset which is your, by the way, your quick ratio is also known as your asset test ratio. So what would do I mean what here is to take is the balance sheet and compute two ratios using the data, and it will help us to understand the liquidity quite well. Let's take a liquidity example and you will have a quick idea on the same. Now I'll give you an example over here. This is the balance sheet of ABC company and the data is for 2016. We have a couple of details over here. In asset side, we have cash, bank, prepaid expenses, inventories, debtors, investments, equipments, and plant and machinery. As you can see, the plant and machinery and equipments are your fixed assets, and this is your current assets. Investment can also be considered part if it is getting materialized in the time span of 1 year. That means it is short-term investments. So these are your total assets. When you sum all this up, it's as simple as that. When you sum all this number, you get your total asset value. And we have a couple of details for liabilities. That is your outstanding expenses, which is 15,000. We have your creditor 25,000, long-term debt that is 50,000. So your total liability is going to be 90,000. And there is some data for stockholders equity also, shareholders equity, retained earnings, that's your profit, basically your reserves, and that amounts to your total stockholders equity as 2,30,000. So your total liability is going to be your total liabilities plus your stockholders equity, that's 3,20,000. We have the amounts getting matched. So from the above balance sheet, from the above data, let's find out the liquidity of the company. See, in this example, everything is given. We just need to find out which one are the current liabilities and which one are the current assets. As simple as that. Now we call this assets current assets, which can be easily be converted into cash. In this example, we have cash, bank, and prepaid expenses, inventories, debtors as a part of it. And current liabilities are those ones which can be paid easily, so which can be paid off within 1 year time span. So in this example, we have outstanding expenses and creditors as a part of current liabilities. So as we have identified now the current assets and the current liabilities, let's compute the current ratio first, and then we will calculate the quick ratio, that is also known as the asset test ratio. So over here, I'm going to write your current ratio. Let's start computing the same. Your current ratio will have a couple of details, that is your current assets. Okay, we'll start with your current assets, and we'll have the amount over here. So we'll start the first thing, cash, bank, prepaid expense in inventory. Let's just copy down the data over here. So this is your current assets data. Let's add all of them. And I think we are missing out one more, cash, bank, prepaid, inventories. Yeah, data is still yet to be written. So Control V, this is your total current assets. That's equal to 1,25,000. And let's, in the similar fashion, let's write our current liabilities, right? For our current liability, we just have your outstanding creditors and expenses. Let's sum this thing up. So we'll get our total current liability. That will be your CL, right? So based on this, we can simply put as your current ratio CR, or we can just copy down this. Your current ratio is going to be your current assets divided by your current liability, which comes to 3.125. So from the current ratio, it's clear that ABC company wants to invest into new projects, and it can, of course, there are other factors that needs to be looked into, but without sacrificing its liquidity, it can invest. Ideally, your current ratio should be close enough to 2:1. That's a good number, meaning that 2 is called great of a company. Here, the current ratio is 3.125 to 1. Basically, you can see to 1, and that's really a good number in itself. That means the liquidity of the company is quite good. Now we'll try and look at the quick ratio. The only difference between the quick ratio and the current ratio is in the quick ratio, we do not consider inventory in the current assets. So that's all the difference it's going to be. Just remove the inventory over here. Automatically, this is going to be your liquid ratio, that is 2.875. That's going to be, just remove inventory over here and do not put in the part of the process. Then you will have 2.875. So from the calculation, it's quite clear that even the quick ratio of MNC company is quite good. Now, this is below is a graph basically depicting the current ratio of Colgate, Procter and Gamble, and Unilever. So Colgate's ratio, we note that, Colgate's current ratio has been increasingly reaching to 1.361. That of Procter and Gamble in the orange one, okay, has declined in the last year and is at 0.877. Unilever's case, Unilever's ratio has been lowest as compared to Colgate and PNG, as it is currently trading at 0.033x. So from the above, we can deduct that, or we can conclude that when we compare the three Colgate, when we compare the Colgate has the best liquidity position, whereas Unilever current ratio is not in a good situation. Now this is the graph for the quick ratio of all those three companies that we just looked upon: Colgate, P&G, and Unilever. We note that Colgate's liquidity is the best. Again, you can see the number in blue, which is 0.855, where thereof, in case of the Unilever, liquidity is in difficult position with its quick ratio of 0.382. So all in all, we can finally recapitulate, or we can conclude that all the investor has to do before an investment is to ensure that they have enough cash and current assets to pay off its current liability. So if that doesn't seem possible, the company can quickly open their balance sheet and compute the current assets and the current liability and calculate the current ratio and your so-called quick ratio. If they see the ratio is more than, let's say, 1.5 to 2, then the company is really in a good position, at least from the point of view of the liquidity. One word of caution here: even if the liquidity is good, that doesn't mean that they can invest a lot of money into project. They need to do an NPV, that is a net present value, and other calculation, to know whether the investment is good idea or not. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.